Good morning, Market Chameleons. Happy Friday, and here he comes, the one, the only, the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
I got the disclaimer up. Do you want to get going with that?
Yeah, let's just get that out of the way real quick and we'll get started. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's the disclaimer. And with that, let me share my screen. So I think for today, I'm going to start out with the pre-market report, but I'm going to try to address a question I got yesterday by an email. It was regarding a call spread. It was a customer who wanted to know, well, why did the stock go up, call spread go down? There's a lot of frustration there. I tried to maybe, take a look at implied volatilities. I could see there was like a frustration, and I think it's a good question. I think it's going to benefit everybody. We're going to take a look why that happened, what you could have done ahead of time to kind of maybe even foresee something like this or strategize differently. I'm not like picking on the question because, and I'll tell you what, I'm a little bit proud of the question. And the reason behind that is that, over time, a lot of people, there's a difference between gamblers and traders. And traders think differently. And if I ever showed you my emails, I basically tell a lot of people to go find different services, because I could tell from the questions. And why I'm proud of this question is here's the person, I think, generally wanted to learn, right? And that's part of trading. You want to learn what happened, like why is it happening this way? Even though you're frustrated, you might not be happy with the outcome, but you want to learn. And when you do that, if you take trades that are good or bad, but you use them as a learning experience, then you're trading. Then that's really more of a trader than just being mad or celebrating, because it went your way. Then you're telling everybody you're right, or you're getting mad and you're blaming. Like it's a learning process. It's always learning. And in any profession, just like trading, you're constantly learning and experimenting. I don't care if you're playing chess. I don't care if you're a sports athlete or a doctor or a lawyer, and that's part of it. So I think that the person really, wanted to figure it out, said use some of it like this, I forget exactly the words, like this defies laws of physics or gravity or whatever, because he thought stock goes up, call spread goes up. But that didn't happen. So we're going to say like why that didn't happen. Okay. So we'll start out with the pre-market report, and then we'll get to the question. I'm going to set it up so you guys can see it visually, and we'll go over those details. Okay. So pre-market report, these are stocks trading in pre-market hours. We got the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here really quickly, see 83 stocks made our percentage gainers list, 90 on the percentage decliners. So mixed bag, maybe a little bit, more towards the bear side. Let's take a look at the S&P 500 stocks first. See if there's a different situation going on there. So I'm going to take this filter here in ETF, and I'm going to pick SPY. So this is going to filter S&P 500 stocks for me. And I see 7 made the percentage gainers list, 4 in the percentage decliners list. So the lists are pretty small. It's Friday, not much going on. So it's a mixed bag, maybe a little bit more favorable towards the bullish side, but the list, 7 to 4, not much going on, just maybe Johnson, I think, I was reading, I think they're splitting off, right? Are they doing like some spin-offs just like GE? So they're up on that news.
I cannot either confirm or deny that, since I have a wife in the house who works for J&J.
Okay. All right. So
I think this morning on CNBC, they said, yes, they're going to split off the consumer product division.
Right.
So
Yeah, so right. So we'll see if that becomes a trend, because I've started to notice that, I think Dell spun off, so sometimes companies get bigger, right? They start consolidating, diversifying. Sometimes they're just spinning off units thinking there's more shareholder value.
GE announced a big one earlier in the week, right? They're splitting into
Yeah.
3 different entities.
Yeah, exactly. That's why I'm like starting to notice like some of these bigger companies starting to split off. And obviously if the share prices are going up, or if we could take a look at the history and see that's been a good do for shareholders, maybe we see more of that going into, and there are a lot of stocks, right? Even Facebook, they could have a lot of components.
Yeah, we had an email from an active chameleon this morning. Rob sent us it. Then it was talking about 4,700 stocks in 1999 in the marketplace. And you and I have talked about this ourselves, and now there are only 37. So there are 1,000 less stocks today than there were, 16 years ago, basically.
Yeah,
and
it's a problem. And I think that it's a problem for capital formation, because we're not, I'm not going to get into this discussion today just to save time, but just really quickly, there's a problem, maybe this blockchain could solve, where we're progress as time goes on. What's going on with our capital markets when it's not serving the middle-sized small companies? It's not right. Something's got to give eventually, because you can't continue on this path where all the capital is flowing very concentrated to the higher end. But
topic for another day. Let's get to this Google
topic
trade.
for another day. Yeah, we'll see. We'll see what's going on. We'll see the new rules with the cryptos. But let's move on to the Google. So here's the scenario here. I'm gonna kind of come to the options chain, and it was regarding a bullish call spread. Okay, so right around here, I don't know if I'm getting it exactly the strikes, but this is somewhere around there. So you're buying the 300 call in Google, selling the 350 call. So this is a bull call spread, right? So this is what you're doing. You're buying a bull call spread in Google. Hold on a second. Maybe, is that the one? Let me just take a look really close to, if you guys hold on a second, let me just see if I'm getting the strikes close or not. I might not do exactly the one, but okay, so it's a higher one. So sorry. Let's do this. I'm going to try to get it, as close, to kind of answer the question. 3,300, 3,350. Okay. So I'm going to load that strategy. And this is a bullish call spread, right? You're buying a call out of the money, 3,300 call. You're selling another call, 3,350. So it's a $50 call spread, and you're buying it somewhere here, let's say $5. So you could see here, the stock has to, if we're looking at, payoff at expiration, stock's got to increase by a sizable amount before it's in the money, and it becomes profitable at expiration. All right. So the idea is, well, okay, I just got the call spread. If the stock's going up, why didn't the call spread go up? All right. So this was the question, and did it make sense to the user? And I think that he did mention something. He took educational courses on this stuff, understood implied volatilities, mentioned a bunch of stuff in the email. So I'm going to kind of go over this scenario right here and what happened. Okay. So when I'm queuing up this call spread, right, 3,300, 3,350, it has different risks. So one, here it's a delta, right? So the delta is how much is this call spread expected to increase or decrease for a dollar move in the stock. So you can see it's not a big delta, 2.5 delta. But what the big risk here is the Vega, right? So you really, at this point, this is a call spread that's way out of the money, okay? So it doesn't have a big delta, but it is something that's further out in time. It has a big Vega. So your biggest risk here is implied volatility at this point, right? That's where this is where we're at right here, right? Look at all your risks here. Here are all your Greeks. Look what your biggest risk is, the Vega position, okay? And when we talk about implied vols, and I think implied vols came in, but remember yesterday, we were talking about implied vols and we referenced the 1 month volatility, a 30-day IV. Well, that's only one benchmark. That doesn't tell you how every option on the board is behaving, right? It's just pointing you to something, right? And that's why I keep showing you guys when we're doing the analytics, look at all the different options, that we're giving, and I'm going to show you how to use the tools today. But that, that implied vol, whatever, and I don't know what tool he's using, monitoring implied volatility or whatever, but that's not telling you how each option, right? Because you got all these different expirations, you got all these different strikes. How are these different options behaving and how are they setting up? Okay, so you see this option has its own implied vol, just like this option and this and so forth. All right, so I'm going to show you first. Let's just take a look at what happened, right? So we have this big Vega position. So really, at this point, it's a bigger risk on implied volatility than it is on the direction of the stock. I'm going to go to the historical charts here, and I'm going to show you what happened here. Okay. So here, this is day by day, and this is looking at this spread. So here you see here, buying the call, 3,300 call, January 21, selling the January 21's 333.50. And this is tracking it day by day, end of day. And you could see here yesterday, this is where the midpoint of that strategy was at the end of the day. And you could see the day before was 510, 650, and so forth. And yesterday, at some point of the day, the stock was up, right? It was up, but this call spread was still below the previous day. It wasn't going up, it was going down. All right. And you could see here, we almost finished unchanged, but look how much it lost in value, an entire dollar, right? So what gives here, right? Why is this happening is the question. And here I'm just looking at the observations, and look, here's the implied volatility of this particular option. Here's the implied volatility of this particular option and the prices, right? So you could see here that the IV on this option fell, quite dramatically. On this one as well. But remember, you're long Vega, right? You're in the position you had on, you're longer the more expensive option. You're selling the with and out of the money option that's further out. So your net long Vega, that's your position. Okay, and it lost money yesterday because implied vols came in, right? It had nothing. It wasn't the stock price that did it. It was the premiums, right? It was the premiums that came in. And that's important to understand. So let's just take a look at it, from a historical perspective, why that's happening. Okay. So just let me know if people are okay so far with this analysis. So there are two ways to look at it. One is we could take a look at it historically from stock behavior, and another is where are usually the implied vols lining up for this option. Did we just overpay? Are we getting a good deal? Like, why is this happening? So I'm going to first take a look at this IV Theo. So this is looking at the last 4 years. If we looked at a similar call spread, same days to expiration, strikes same distance away, and we looked at the premiums, right? Where were they on average? So you could see here on average, we're looking at this call spread would be $3.59. So if you're paying $6 or whatever it was, right, on the high end, well, what's happening is that even though, the stock is going up, the premium you're paying is actually you're paying where it has to go up much faster than usual, right? What you're doing is saying that, I'm very confident that this stock is going to keep going higher, or those higher premiums are going to be maintained. So even if the stock goes up and you're seeing these premiums starting to revert to the mean, this is what's happening right now in Google. Okay, so you could see here that, remember, it was 610. What was it? On the higher end. So you could see here, what's happening, right? And by the way, like, I'm just, this spread, it's pretty wide. Google's like, so this depends also where you bought it, right? Because if you're just paying the offer, we talk about it every day, and I try to do the show every day. Not everybody finds me entertaining. It's the problem, right? Because you have to learn. You have to kind of sit through here and learn, but it depends where you're buying it, right? So if you're buying it at 580, right, and this is 240, 580, you're really paying up, on top of just based on historically, you're paying up just based on that fair value. You're like 410 is the midpoint, you're paying 580. I mean, it's like 30%, over mid-market. So, even probably more than that. So all these things you have to take into consideration, or else things aren't making sense to you because you're just not looking at everything, right? How everything is lining up. So let's just take a look. So we're looking at the IV-Theo. So we see from a historical perspective, like here, we're on the high end of that range. So at 359, at 359 mid-market, you could definitely try to get it below 359, right? The bid is 240. So it depends where you're putting in your limit orders. So here it's not just the analytics, but what counts is your execution, right? Where are you getting executed on your trades? It makes a big difference. Let's take a look at, though, from a historical distribution. Like, these are where the premiums line up. How likely is this stock, move historically, that these will be in the money in the winter? So we could look at it from distribution historically. So if we use the last 4 years, here we only have four observations because there's a lot of days here, 48 days. So what I'm going to do here is, instead of using, going back 48 days, I'm going to switch to this to rolling days. And what this will do is just show me from any point in time, 40-day period, how did the stock do? So if there's any outliers out there, kind of remain in there. So you could see here, using rolling 48 days, historically, the way the stock behaved, right, on average, this spread is worth 447. So if we're looking at the previous day, $6, still paying up, and the likelihood, of it being profitable, if you're buying it on the offer, is 10.9%. So the point I'm trying to make here is, yes, you put on a spread that has a delta and it's bullish, but there are other factors that you have to consider, your risks that come into play, and actually your exposure here, your biggest exposure was not even the direction, it was the implied volatility. You actually had a long Vega position on. That was your biggest exposure here, right? Let's come back to it. Hold on a second. Well, here, I'm coming back to it. See here, two and a half delta. You have like almost zero gammas. This isn't moving, but you got a very big Vega position. That's your biggest risk that you had on, was Vega. is that any question? Hopefully the person's listening, if not, it'll just benefit, the rest of the people, but
Wait, we didn't send him an email. I guess that's my job. I forgot to send him an email letting him know you were going to be talking about his question today.
Well, I did tell him because he was very persistent, wanted to know the answer to it, and I tried to point him, I tried to say, go talk, ask your broker because they could really maybe, get on a phone with you. That's what your broker's there for. You're paying them commission, you're holding money with them, and, that you could call them, right? They should be able to answer your questions about your.
Wait. You think the broker would be able to answer the question you just answered?
Probably not, but they should.
It's funny because people were talking about Wolves of Wall Street, and by the way, quite a few of the chameleon community. Laurent tossed out, I believe Dimitri is very entertaining. Alex says Dima is the best. He's so entertaining, he could teach my dog to trade options. So, there was some good commentary about you, D, which is always nice.
Thank you. No, I appreciate it. Look, people, when we have people for a long time, been with it for years, and I could see the emails coming in, the questions are becoming more sophisticated, like learning a lot, and I'm very proud. Look, I'm actually pretty proud of this question because I do believe, there was frustration because the person, I think he said he took educational class, he took courses, paid for them, did say he wasn't in it for a long period of time. Things he understood implied volatility. So that's why I chose to take a look at this specific and answer the question he had. This is what I told him you could come on a show live and ask your question. And if something doesn't make sense, no problem. I'm going to try to address it, but this is what I see happen based on the question that I'm getting emailed. And it's good to know why, right? And don't even get upset about it didn't work out, right? Did you learn something going forward, right? Did you actually learn to be better going forward? And if you did, then it was worth doing the trade. It was worth even losing on the trade because now you learn something going forward. And how do I look at it differently? Maybe next time I'll look at it differently and say, hey, you know what? Maybe I'm paying up for it. And what would have worked better, right? So let's take a look. The stock went up, so he had that, his outlook was kind of correct on the direction of the stock. Maybe the strategy that he put on wasn't the best. So maybe, given this situation, let's take a look at maybe an out of the money put spread, right? And out of the money here, 270. I'll just put it in there right now and see how this worked out. So, and that's why we're using tools kind of as guidance, right? So now we have a put spread, same thing, right? Delta, we're not long too much delta here. It's kind of bullish, short a little bit of Vega. Let's see how the IV Theo is lined up. So so maybe not, maybe you don't want to sell it 750. That's too low, but it gives you kind of a reference point. Look how wide this is. 955 is the midpoint. Do you put it out at $10 and maybe you get lucky and get hit 1050? It makes a difference. Your executions over a long period of time make a big difference. But now we're getting kind of reference points of, hey, I want to get it above there, right? And if I don't, I'll move on and find a different trade, maybe, but or unless you're very confident that this is the trade you want. We could look at the distribution Theo, say, hey, you know what? I don't know if I want to sell this, until I get more. But the prices you're doing it at, the executions make a difference. It's a big deal. You want to be, if you're paying up, you have to have a reason. I'm not saying I pay up sometimes it doesn't matter because there's a reason behind it, but I need that reason, right? I need to justify it. If I can't justify it, then I default back to my statistics and see where are we relative to the historicals. So that's kind of like, where he formed, I think, in the setting up this trade, he had a bullish out, and he put on what he thought was a bullish trade where his exposure was, a delta directional. But in actuality, when we take a look at the strategy, it was more of a long Vega position. All right, it was an implied, and not only what is it implied, it was a skew, because you're buying one option and selling another option. So this is what this is telling us: is how do these line up versus each other? Because it's not only long Vega, you're actually trading the skew when you're doing a spread. You're buying one option, you're selling another option at different implied volatilities. So now you also have a skew on. So how does that skew look like versus historical measures, historical standards? So you got a couple things going on there. And as long as you're learning, I think it's okay, right? As long as you're learning, as long as you're not doing like, crazy, risk plays that you shouldn't be. I think over time that's fine, because look, I will do a lot of trades to learn with expectations. I'm hoping just to break even, make a little, lose a little, but I need to learn, like, wait, how does this play out? You can't, unfortunately, learning, it's not just reading or listening, but it's experience, right? It's also the experience of doing it. So sometimes, like, I can't learn how to play guitar by just watching somebody. I have to actually try to play the guitar, right? Or I can't just learn how to play basketball by watching an NBA. I have to pick up the ball and do it. So the experience is part of the learning. Does it, any questions on there? Hopefully people found that helpful.
Yeah, I think they find every episode helpful, D.
Okay.
Alex was asking about this. I mean, this is off topic, but people love Donald's discussion about this volume profile. Could you show again where you showed we have something about the volume on the site?
Yeah. So when we go to a individual stock, what we have is like a price action tool, and it's really pricing. A lot of it is price and volume, right? So, like, for example, just the VWAP alone during the day. And what he showed was you could go back, but this kind of gives you, like, this is what the chart looked like yesterday. This is where the biggest, volume bar was, like right there. Right. So you hover over it, it tells you the volume and the range, the price range. We use VWAPs plus the volume. And so that's one of the things you could look at. But down here, you got minute by minute, right? The number of trades. You could take a look at sweep trades. You can take a look at odd lots, dark pool. You have a breakdown here. So there are different types. When we talk about volume, not all, if you look at the tape, it's not all the same. Okay. Like, here, I'll tell you here, large block trades here, right? So one time you could lump all the trades together, but the volume could tell you different stories, right? Like one trade that crosses for $1 million worth of stock can tell you a different story than if you just had, in 1 minute, $1 million worth of stocks traded from, different small sizes. So this is more of a detailed breakdown of the volume. So you get all these different price actions. So it's not just one bar, but it's kind of like, okay, what's happening throughout the day? So what's happening in the dark pools, what's happening with the large volume trades, what's happening with sweep trades, so you could kind of go in there and start analyzing those details. Where's, what happened for example, at the opening closing, right? So the opening closing, those are also, big volume. You're going to get big volumes at the close, big volumes at the open. Those could tell you as well something different, because why is there so much volume queued up at the open or at the close? Like, why does somebody need the opening price, or why does somebody need the closing price? How does that compare to the pre-market? So we kind of go into more breaking down details of it. I think what he was showing us is really just like, here's the biggest volume, bar. So it's a little bit different approach. His was more, let me see here. I think what he was showing us was more of this, right? Where the biggest volume was relative to the day, but he had the ability to go back days, so here we're just showing for the most recent day. Does that help answer the question without having a very specific question? Just
well, and that's, again, the interesting thing about Donald is that's one of the key features he uses. For, you and I, it's not a big piece of our work, what we use. So, I think with Donald, this is like he builds his trades, around this, which is probably interesting. And we will try to get Donald back on. He did say he would give a whole webinar on it, and I will reach out to him.
Yeah, and what we'll try to do as I'm building it forward, and I'm doing the alerts, is combining these, combining what's going on in the options, what's going on in the stock, trying to see if, because right now I could understand it, unless you know what you're doing and looking for, you have to really dig deep in there and find, the very unusual buildups, so as I'm building out these alerts, I think this will improve, point you to more stuff. But at this point, you have the data there, but it's up to you to kind of go in there and really analyze. And some people do, they'll use our option block trade screeners, they'll use our repeat order trade screeners, they'll use big money stock flow, so people do use those, to drive some decisions.
Awesome. Well, we do have a webinar that is organized coming up this Monday. Jay Soloff is coming back. He was a floor trader. He's going to have an interesting webinar on Monday at 6. We have Raj, who's doing a webinar. He's a chameleon who set up the Discord channel with Jake. He'll be coming on Tuesday. We have Felix Frey, one of our favorites, is coming back for a webinar the next Monday. Then it's Thanksgiving, and we will try to get him hopefully into December. I'll try to get Donald on the books for a webinar. D, how's that?
Yeah, that sounds good.
And it's 2 minutes into the opening trade. So with that, I'll put Jay's link in the chat. Thanks everyone for joining us. Great job as always, Dima. Thanks so much, my friend.
Thanks everyone. Stay safe out there. Have a good trading day, and hope to see you guys Monday. Right?
Trade in peace, chameleons. Awesome job. Bye.
Bye.